Welcome aboard Top Gun Options Market Intelligence Brief. I'm Matthew Buckley, call sign Wiz. Let's get started. We're taking a look at a potential trade on Google, potential earnings trade to add to our primary model portfolio. Everything here at Top Gun Options is skill-based, so primary is geared to those folks who are relatively new to options, and then we have intermediate and advanced that is more geared to folks who are more intermediate and advanced who know what they're doing trading options. So our Trade Alert primary portfolio is actually doing pretty good year to date. I believe we're up over 19% year to date in 3 months. Yep, year to date about 19% over 3 months there, so that's looking pretty good. As far as our performance. So also in our model portfolio, hold positions in Amazon, Bank of America, the GOOG position we're going to talk about, a very bullish double vertical on USO, and a bullish, long-term bullish trade on volatility, short-term bearish, a VXX diagonal. But let's get to Google. Our strategic mindset is, well, earnings season is approaching for some heavies in the market, both in tech, such as Google, and actually the financial space. Goldman Sachs, Bank of America, for example, have earnings coming up in April. And while these industries don't appear similar on the surface, they do tend to impact the overall market sentiment and direction. So our strategic mindset at Top Gun Options continues to be market neutral. We're trading with the trend. Remember, don't fight the tape, while keeping one eye on the exit for the day that someone yells fire and actually means it. So our primary model portfolio is aligned with this mindset. Like I said, we have a diagonal on VXX that is long-term bullish on vol while being short-term bearish, and we have a similar position in Bank of America. But our target today we want to talk about is GOOG, currently trading at about 655. Our commit criteria, just like we have flying fighter jets, we don't point our nose down range and commit our aircraft, our ship of 4 F-18s against a bad guy unless it hits certain criteria. And we call that commit criteria. Same thing with our trading capital. GOOG reports earnings on about 4/18, so this trade takes into account the historic movement in implied volatility around these earnings events. If you take a look at a one-year chart of Google, for example, you can see it has some pretty wild swings around earnings and implied volatility. All these little E's on this Trade Monster platform represents earnings on Google. Implied volatility around these earning events usually surges roughly around 40%. So that's our commit criteria. We're taking an overall neutral stance on earnings on Google itself. Excuse me. So the tactic we have chosen suits our strategic mindset and our commit criteria. And as you can see on this chart, Google tends to move and gap around earnings. And if we bring in our radar to about let's just say the past 20 days, you can really see that the not so invisible hand of the Fed has obviously helped Google out as well as the overall market. So let's take a look at our specific tactic. Again, we go from a strategic mindset down to a tactic, folks. Most retail traders do what? They go right to dessert. They go right to the tactic, which is absolutely wrong. Hey, I'm going to trade Google today. I have no idea why. Exactly the wrong way to do it. So we're looking at an iron condor, and let's take a look at the 590. Let's start building our spread. 590. Let's create a spread here. And if you want to open a free paper trading account, all you have to do is go to trademonster.com/TGO, and you can open a free paper trading account and get access to all these pretty cool tools. I'm going to edit these legs. I just like playing around with my colors here. Selling the inner strikes, buying the outer strikes of an iron condor. We're going to be buying the 585 downside put as protection, selling the 590. This makes, and we're going to do it 15 times because that equates to roughly about a 5% risk in our model portfolio. Our trading rule of engagement at Top Gun Options in the primary portfolios never risk more than 5% of our portfolio on any one trade. So right here is our bull put spread, the 590, 585. It's April. That's checked. And then we want to sell to the upside, the 700. I'll scroll down here and grab the 700 and 705. There we go. Scrolling down here. And folks, this is what we call an iron condor. So let's go ahead and create an order and see what mid-market would be on this position right now as it trades at the market. Let's go right mid-market, which is right about there. So it looks like about $1.50 we can take in as a credit. And let's analyze this. You just click Analyze on that Trade Monster platform. And this iron condor has let's just round up and call it a 68% chance of retaining all of this credit, or $2,200 $2,250 there. It's got a 28% of suffering the max loss, and it's just $250 north of our trading rule of engagement. But again, as the pilot in command of this model portfolio, I'm okay with that $250 above. That's why I'm the pilot in command, and you're the pilot in command of your own portfolio. You make all these risk decisions on your own. And since it is an iron condor, if you're new to iron condors, guess what? The stock can't magically split and go in two directions and hit both those short strikes. It can only hit one of them as a worst case scenario. So the break evens are down there at 588.50, levels not seen in months, and all the way up there at 701.50, obviously levels not seen in a long time, if at all. Here's that big threat that we talked about, earnings. Earnings are on 4/18 and expiry is on 4/21. That's the Saturday, so call it 4/20. So the week of expiration, it's volatile anyway. We're going to see a huge spike in volatility. We're not going to see, although theta helps us in an iron condor, not in this position. The volatility is going to offset any potential benefits there. So let's create this order, confirm it, add it to our model portfolio, taking in a credit of 22.50 there. The exit tactic is simply to reverse this trade to get out of it. But we're really looking to stay engaged with this position through earnings. So we can collect that max credit. But folks, big threat, Google's a bucking bronco around earnings. You can literally feel the market hold its collective breath waiting for the announcement. And this fuels that run-up in volatility that we talked about. The instant earnings are announced, stock gaps one way or another, and we see that volatility crush. So folks, we selected, bottom line, a bull put, bear call spread, and iron condor with $5 wide strikes to help us manage that risk. If we wanted to take more risk and potentially take in more of a credit, we could have selected what? $10 wide strikes, right? But this would increase our risk significantly. And in the primary model portfolio here, Top Gun Options, we're comfortable with $5 wide strikes on this trade. And if the stock gaps up or gaps down through one of our short strikes, we will close that leg as quickly as possible to limit our loss. And as always at Top Gun Options, we close a trade if any of our commit criteria change for any reason. Matthew Buckley, call sign Wiz with Top Gun Options, saying happy hunting, make sure you hedge.